Welcome to Ekesha's Foreign Exchange Made Easy class. Today is 22nd session. Today I will start Black and Scholes model, problem and its solution. The Black and Scholes model. It is most popular and relatively simple and is faster to compute the price of option derivatives and is mainly used for European option. You know what is European option and American option. Still I repeat it. European option can be exercised by the buyer of the option only on the expiration date. In India, all the options are European type. An American option can be exercised by the buyer any time or before the expiration date. Currently, American options are not allowed in India. Now, to calculate the theoretical price of option trading, it uses 5 key determinants of an option price. Number 1 is stock price, number 2 strike price, number 3 volatility, number 4 time to expiration, and number 5 short-term risk-free interest rate. What is risk-free interest rate? The interest rate of treasury bill or government bond is taken as risk-free interest rate as because the government is the borrower and borrowing is in home currency. So there will be no possibility of default by the borrower as government can print the money and pay off the lenders. Next come assumption of Black and Scholes model. No dividend are paid out during the life of the option. If dividend is announced by the company to be paid within a certain period of time or it is expected, then the present value of the dividend should be deducted from the stock price. There are no transaction cost in buying the option. The return of the underlying assets are normally distributed. Markets are random, that is, market movement cannot be predicted. The option is European and can only be exercised by expiration date. Call and put option price can be calculated from the formula it is given. C, that is theoretical call premium, is equal to S. S is current stock price into N into D1. N into D1, what is N? N is cumulative standard normal distribution minus K. K is the strike price. K is the option strike price. E to the power minus RT. E is exponential term. It is the value is 2.718. E to the power minus RT. R is equal to risk-free interest rate. And T is time until option exercise into N into D2. And P is theoretical put premium. K is the strike price into E to the power minus RT. R is equal to risk-free interest rate and time. T is equal to time into N into minus D2 minus S into N minus D1. What is N and N D1? N is the notation for calculating the probability under the normal distribution, and ND1 represent the cumulative standard normal distribution of the value D1 that gives a probability that the option will be exercised profitable. And ND2, it is the probability that if the option is exercised, we would have to pay the strike price to acquire the underlying asset, considering the present value of the strike. Now, D1 is calculated from this formula. ln S by K. ln is natural log, S is stock price, by K is strike price. And R plus R is rate of interest plus sigma square. Sigma is the volatility or standard deviation by 2, sigma square by 2 into T, divided by sigma into root T. And D2 comes D1 minus sigma into root T. Come to a problem. From the following data for certain stock, find the value of the call option. What is given? Stock price S is given rupees 80. Exercise price K is given 75. Standard deviation sigma is given 40%. Maturity period T is given 6 months. And annual risk-free interest R is equal to 12%. Applying the Black and Scholes formula, value of the call option will be C is equal to S into ND1 minus K into e to the power minus RT into N into D2, ND2 is equal to putting the value of S 80 into ND1 minus strike price value is 75 into e to the power minus 0.12 that is T into 0.5 that 0.12 that is rate of interest and 0.5 is the T into ND2. And D1 is calculated from the formula ln natural log into S by K, stock price by strike price, plus R plus sigma square by 2 into T divided by sigma into root T is equal to ln 80 by 75 plus 0.12 plus 0.4 square by 2 into 0.5, that's divided by 0.4 into root 0.5. And D2 is equal to D1 minus sigma root T. Now D1 is equal to ln 80 by 75, which is I have already written 0.12 plus 0.40 square by 2 into 0.5 divided by 0.40 into root over 0.5. S by K is equal to 80 by 75 is equal to 1.0667. Now ln 1.0667 is equal to ln is natural log is equal to 0.0646. This value is arrived from the Excel. The syntax is ln bracket 1. Syntax is equal to ln bracket 1.0667 bracket close is gives you the value of 0.0646 and sigma squared by 2 is equal to 0.4 square by 2 is equal to 0.16 by 2 that is equal to 0.08. Putting the value that is R plus sigma square by 2 is equal to 0.12 plus 0.08 into T 0.5 divided by 0.40 into root over 0.5 and that comes to 0.2 into 0.5 divided by 0.40 into 0.7070. D1 is equal to 0.1646 divided by 0.2828 is equal to 0.5820. and D2 is equal to 0.5820 minus 0.2828, that is sigma into root 0.5 is equal to 0.2828, then that is D2 is equal to 0.2992. Now you find out the value of the ND1, that is N 0.5820. 0.5820, the value will be 0.7197 from standard normal chart. Now you consult normal chart 0.58. You see here 0.5, 0.58, it is 0.7190. 0.7190, you put the value 0.7190, instead of that it is written here 0.7197 due to the another factor is 0.5820. I have taken only 0.58, and in the table there is an additional chart for 0.002 that is not given in the chart, so it is given taken as 0.7197, is very negligible value, and D2 is equal to N into 0.2992, that is equivalent to 0.3. You consult it 0.30. 0.30 is equal to 0.6179. You see ND2 is equal to 0.6176. 6179, instead of this I have taken 6176. And C is equal to S into ND1 minus K into R to the power K into E to the power minus RT into ND2. E to the power RT is equal to E to the power minus 0.12 into 5, that is equal to E to the power minus 0.06, that gives the value of 0.941765, and e to the power 0.06 means 1 by e to the power r, that is equal to 1 by 0.941765, that is equal to 1.062. This value you can derive from the Excel. The syntax is EXP bracket bracket minus 0.06. You will get the value of this. If you put value 0.06, you will get the value of 1.062. So C is equal to 80 S into ND1. ND1 value is 0.7197 minus 75 K by e to the power RT 1.062 into ND2. ND2 is 0.6176. Now C is equal to 80 into 0.7197 minus 75 by 1.062 into 0.6176, that is equal to 57.5757 minus 70.62 into 0.6176, that is equal to 57.57 minus 43.61 is equal to 13.96. Price of the call bar is equal to rupees 13.96. And the value of the put option. Value of the put option, the formula is P is equal to K into R to the power minus RT into N into minus D2 minus S N into minus D1. Now D1, the same formula, you apply this, and what is derived in the problem, in D1 is equal to 0.5820. Here it is written D1 is equal to 5820, and the in D1 we have calculated that 0.7197. So n minus D1 is equal to 1 minus n D1 is equal to 1 minus 0.7197 is equal to 0.2803. For D2, it is already calculated 0.2992, and ND2 is 0.6176, and N minus D2 is equal to 1 minus ND2 is equal to 1 minus 0.6176 is equal to 0.3824. Now P is the theoretical put option value, K into e to the power minus RT into N into minus D2 minus S into N into minus D1. Now 75 is the strike price divided by 1.062 into 0.3824. You see, N minus D2, the value is 0.3824, and minus 80 into N minus D1 is equal to 0.2803. You get the value from here, 2803. Now multiply with 70.62 into 0.3824 minus 22.424. That is equal to P is equal to 4.576, and C is equal to 13.96, because C is higher, because the call option is in the money situation. That is, strike price is lower than strike price 75 is lower than the spot price. So is it the position is in ITM, in the money. But for the put option, it is OTM. That is, strike price is less than the spot price. So the put option value is lower than the call option value. Call option value is 13.96 and put option value is 4.576. And this curve you practice it, otherwise it will be difficult to find out the value. Problem 2. Following information is available for X company shares. Now share price is 185. Strike price is 170. T risk-free interest rate 12% and 6 month time and 0.40 is the standard deviation. Find out the option call and put using Black and Scholes formula. Simply you add the formula, put the value in the formula. First you find out D1. First you find out the D1, that is ln x by k plus r into sigma square by 2 into t divided by sigma into root t is equal to ln 185 by 170 plus 0.12 plus 0.40 square by 2 into 0.5 divided by 0.4 into root over 0.5, and ln 1.0882, the value is 0.08452 plus 0.1, because 0.12 plus 0.08 is equal to 0.02 into 0.5 is equal to 0.1 divided by 0.2828 is equal to 0.6524. Now when you calculate the D1, Then you calculate D2. D1 minus sigma into root T is equal to 0.6524 minus 0.2828 is equal to 0.3696. And ND2 is 0.3696 is equal to 0.6406. You consult the chart, that is 0.3696 D2. 3696, that is 0.37. You come here, 0.37 is 0.6443. Plus minus, very negligible amount will be 0.6406. And 0.6524, 0.65, you come here, 0.65 is 0.7422. 0.7422. That is ND1 0.6524, you get the value 0.7422. Value of the call option. SD1 is ND1 minus K into e to the power minus RT into ND2. Put the value 185 into 0.7422, that is ND1, minus 170 strike price e to the power minus 0.06 into ND2, 0.6406 is equal to, you calculate it, you will find out 34.77, the option value of the call. And when you find out the P, that is option value of the put option, the D1 is already calculated 0.6524 and D2 3696, and N minus D2 is equal to 1 minus ND1 is equal to 1 minus 6406. The value of the ND1 for the value D1 is equal to 6524 is equal to 6406 is equal to 0.3594, and N minus D1 is equal to 1 minus ND1 is equal to 1 minus 0.744, that is the value of the ND1 is equal to 0.2578. Now P is equal to e to the power K into e to the power minus RT into N minus D2 minus S into N minus D1. Put the value of the 170 into e to the power minus 0.06 into 0.3594 minus 185 into 0.2578 is equal to, putting the value and calculate you, that is 9.83. Here the put value is lower than the call value, call option price, because it is in the money position for call option, call buyer. Now this problem you can solve it, that is strike price is given, exercise price is given. You see here it is item of put option, that is stock price is less than strike price. So put option buyer is on the position of item, and all others figure is given. Simply put the value P is equal to K into to the power minus RT into N into D minus D1 minus S into minus D1. Sorry, N into minus D2 minus S into N into minus D1. D1 is the same formula, and D1 you put the value, you will get D1 is equal to 0.0544. Now when you calculate D2, then you get minus 0.2284. Minus 0.2284. So when you find out the n minus d2, so it will be n d2. Minus minus, it will be positive, and n d2 0.2284. You will consult the formula 0.22, that is equal to 0.5871. 0.22 is equal to 0.5871. You see here, the n d2 is equal to 0.5871. Here it is minus, so it is minus d2. It becomes n d2, positive d2, and put the value of positive 0.5871. And n minus d1 is equal to 1 minus n d1 is equal to 1 minus 0.5199 is equal to 0.4801. Put the value in the equation, p is equal to this. You will get p is equal to 20.67. The figure is given also in minus form. Here it is given in the positive form. So 1 minus n d1 is equal to n minus d1. This is another problem. You can solve it. Now come the last problem. Calculate the price of a 3-month European put option. T is given 3-month European put option on a non-dividend paying stock with a strike price of rupees 50 when the current stock price is 50, that is ATM, at the money. The risk-free interest rate is 10% per annum and volatility is 30% per annum. The price of put option, you know, P is equal to K into e to the power minus RT into N into minus D2, N minus D2 minus S into N minus D1. What is given? S is equal to 50, K is equal to 50, R is equal to 10%, T is equal to 3 months, that is 0.25, and sigma is 30%, 0.30. Put the value. First you calculate D1, and from D1 putting the value of in the equation, that is ln 50 by 50, that is 1, ln 1 is equal to 0, 0.1 plus 0.30 square by 2 into t 0.25 into sigma into root over t, that is 0.3 into 0.25 is equal to ln 1. It is, the value will be 0, it is shown here, and r plus 0.30 square is 0.09 by 2 into t 0.25 by sigma into root 0.25 is equal to 0.5. Now D1 is calculated here 0.2417, and D2 is equal to D1 minus sigma root 2 root t is equal to 0.2417 minus 0.15. Sigma into root t is equal to 0.15 is equal to 0.0917. Now you have to calculate n minus d1, which is n into 1 minus n d1 is equal to 1 minus 0.5950 is equal to 0.405. Now n d1 is equal to 0.2417. So you see 0.24. Rest figure I cannot find out because that additional chart is not given here. 0.24 is 0.5950 5948. 0.24 is 5948. Here you see 5950. It is taken as 5950 because the figure is 0.2417, so 0.002 is added here, and 1 minus 0.5950 is equal to 0.405. And next, n minus d2 is equal to 1 minus n d2 is equal to d2 value of the d2 is 0.09. You come to figure 0.09, you see here it will be 0.5359, 0.09, 0.0917, 5253, 5359, sorry. Here it is taken 5359, 1 minus 5359 is equal to 0.4641. Now e to the power minus rt is equal to e to the power minus 1 into 0.25 is equal to e to the power minus 0.025 is equal to 0.9753. Now put the value k, p is equal to k into e to the power minus rt, n into minus d2 minus s into n minus d1. Now 50 into 0.9753 into 0.9753 is e to the power minus rt into 0.4641, which is calculated here, and minus 50 into 0.0405, it is n minus d2. You will calculate that p is equal to 2.38. Next day I will continue this class, this problem. Also call and put parity, put and call parity, and also the American model, binomial model of American style of option. Here I stop the class. Next day I will discuss this. It will be continued and discuss put and call parity and also problems of binomial model, that is American option. Thank you.